calculate total income. So just basically anything, tips, salaries, tips, investment income, education income, including scholarships, and grants in excess of college expenses. So that's the thing to remember. If you have a scholarship, let's say for $10,000, and your college expenses are for $11,000, you don't have to claim any of those scholarships.
For taxes.
For taxes.
Tax purposes. But if go ahead.
No, you're fine.
If you got $10,000 and your college expenses were only $8,000, then you have to pay taxes on the extra $2,000.
$2,000. That's why, students, you need to wait until March 15th, because that's when the university sends out their 1042-S forms about scholarships. So non-residents, you include economically connected income, U.S. income earned in connection with schooling or a business. Okay, in the U.S., gross income also excludes certain things. Again, scholarships or grants not in excess of college expenses. Interest on U.S. savings bond.
You don't have to pay taxes on it.
And also, if you contribute to a 401k, which is a company retirement plan, your contributions here are excluded. So for example, if I make $50,000 last year and I put $5,000 into a 401k, how much do I have to pay taxes on? Do I pay taxes on the whole $50,000? Actually, no. I pay taxes on the $50,000 minus that $5,000 that's excluded. So I pay taxes on $45,000. So I get a tax benefit now. Christine?
Well, a 401k is tax deferred, right? So when you pull the money out to use it after retirement, you tax it.
Yeah, so the downside about these is you put money into these before tax. When I pull it out at retirement, I have to pay taxes on it. Also, this magically converts long-term capital gains into ordinary income, which is taxed at a higher rate.
So you also pay taxes on the money you made on it too.
That's right.
So you pay it on the principal and the interest that you made on it.
The difference with a Roth 401k or a Roth IRA, I don't get no tax benefit now, but when I pull it out at retirement, I don't have to pay any taxes at all.
Even on the gain? Yeah,
even on the gain. So I recommend most students, we had a goal that when we retired, we wanted to have 1/3 of our assets in taxable accounts, 1/3 in Roth accounts, and 1/3 in tax-deferred accounts. So that way we can target our tax rate in retirement.
And for non-residents, there's no exclusion.
Yeah, sorry, non-residents.
Okay.
And then you subtract adjustments. To get adjusted gross income, again, there's different adjustments. I don't know why, but a 401k is an exclusion to gross, and an IRA is an adjustment. I don't know why that's the case, but it's kind of weird. But again, that's an adjustment here. And then non-residents, there's just not much. There's a couple things. There's some minor adjustments. Realize that governments tax non-residents higher than they do residents. So that's just what all governments do.
Sorry, guys.
Yeah, sorry. And then you determine your taxable income. What you do is, in the U.S., you can either do a standard deduction or itemized deductions. In the U.S.,
so remember, the standardized deduction is the set amount, and the itemized is when you keep track of everything.
In the U.S., the standardized deduction is $30,000 in 2025. Mm-hmm. And non-residents, there's a couple of deductions. Number one, your state and local income taxes, you will find that on your W-2 form. So make sure when you fill out your taxes, you have your W-2 form close by. The other thing, too, is gifts by check, so donation to the church for tithes and offerings. You want to make sure you have your church receipts, too, for the tithes and offerings that you paid.
For your tithing declaration.
Tithing declaration form. U.S. itemized deductions, things like charitable contributions. Interesting thing here, we all pay our tithes and offerings. But there's an interesting thing too, if you can actually do donations in kind. So Sister Sudwick's and I will sit down once a year and we'll estimate what's our earnings going to be for that year. And instead of doing cash, what we'll do is we'll donate the shares of the mutual fund or stock. So let's share that example quickly. Let's say the stock is worth $20 and I sold it, say I paid $10 for it, how much capital gains do I have on that stock? $10.
You bought it for 10, you sold it for
20. So
you
I'd
have
have to pay
$10.
capital gains on $10, which is usually around 15%. What happens if I donate that? So then I take that money and pay my tithes and offerings. What happens if I donate the shares directly
to
the church? Xander, what happens? No taxes.
So the church gets the full $20 that it's worth, and you don't have to pay taxes on the capital gains because you didn't realize it. You just donated.
Now, what does the church normally do after that? They'll just sell it. But do I care what the church does?
Nope.
No, because my responsibility is to pay my taxes to the Lord.
To pay your tithing.
Pay my tithing.
Okay.
Okay, so here's some other ones. How do you calculate your tax liability? Figure out how much your taxes are. And notice here,
Figure out how much your income is.
how much your taxable income is. And then it's 10% of the first amount up to $11,925, 12% on any difference between here. So if you had taxes of $50,000, you'd pay 10% on the first $11,925, 12% on this to this, and then 22% on the difference between $48,475 and $50,000. The good news is we have spreadsheets.
This is why they call it progressive, because you pay 10% on the first amount, 12% on this, between this, 22%. So the more you make, the more you pay. But that's how it works. But we have a calculator to figure it out.
They figured it out for you.
So.
Okay.
That's just
So key points on tax liability. Go ahead.
The tax rate is progressive. At the higher income brackets, the tax rate increases, but only for the portion of income in that particular bracket. The marginal tax rate is the rate of tax paid last, so the rate at which the next dollar is taxed. And the effective tax rate is the total tax liability divided by the total income or economically connected income.
Every one of you are going to have to figure out what is your marginal tax rate and what is your effective tax rate.
But most of the time
for international students, almost everyone I've seen, your marginal tax rate's 10%, your effective tax rate is 9% or something like that, because you can subtract your state taxes.
But we have a calculator to help you figure it out.
Yeah, and we'll show you that in just a minute. So, major tax credits. If you're in the US, our favorite one is child tax credit. So when we had with 7 kids, we've paid hardly any federal tax. Now we pay a lot more because it's just the 2 of us.
Yeah.
There's American Opportunity Tax Credit, which is for education, lifetime learning. If you want to go into more detail on this, if you go to the BYU Idaho website at byui.edu/personal-finance, there's a lot more information there.
More than you want to know.
Yeah. Non-resident, there's not as many. You really don't get the child tax credit. Unless you're from India. India has some tax treaties with the US, so they pay less taxes. And then any taxes paid. And the nice thing about tax credits, they reduce your taxes dollar for dollar. So credits are much, much better than...
They're much preferred over tax deductions.
Yeah.
Tax credits are either refundable, so you get the money back, or they're non-refundable.
Even if
so
it
you get the
exceeds your
benefit.
tax liability.
Yeah, if it exceeds your taxes, so say you got a tax credit of $2,000, but you had to pay,
Your tax
you
bill
didn't
was
have to pay any taxes, then you'll still get back $1,400.
$1,400, right. So non-refundable means you get the benefit up to your tax liability. Refundable, you get money back even if it exceeds your tax liability.
So they didn't owe any taxes, so they got $1,400 back instead of $2,000. But
Yeah.
they could use the $2,000 towards their taxes if they owed taxes.
Yeah.
Okay, let's see.
Sorry, limited benefits. Okay, here's the question. How do you get to decide how much taxes are taken out? So as international students, you guys had to fill out a W-4.
When you first started your job, then they come to you and give you this form to fill out. And this form helps you decide how much tax is going to be withheld from your paycheck.
So generally they just look and say if you're single or are you married, Those are the main ones. But you can actually fill that form out. They actually have a recommended withholding for most of our iWork students.
So if you have like a couple kids, you're going to want them to withdraw more money because you're not going to pay as much in taxes.
Less money.
Withhold less money,
Right.
because you're not going to pay as much in taxes. But the reason that you have them withhold money is so that at the very end, when you fill out your taxes, you won't have this huge tax bill that's due, because you already had a bunch of money withheld, so that will either, if they withhold too much, you get a refund. If they didn't withhold enough, then you have to pay.
Ideally, you want to have, it should be pretty close, so you don't have to pay or you don't get a refund.
It's kind of nice if it's zero, but if you get a refund, everybody always loves a refund, but they have your money longer than you have your money, so.
So again, the W-4 is an important form. Okay, what are the differences? So again, number one, U.S. residents, we can use standardized deduction or itemized deductions. 1040 non-residents can't, unless they have the tax treaty with the U.S., such as India. So Samantha, Nadraj, you guys have benefits here. Number two, U.S. residents can use multiple filing statuses, such as married, filing jointly, and head of household. Non-residents aren't allowed to use those two. So non-residents only have two filing statuses.
What are the two?
Filing single and married filing single.
Okay. But what if one of them's a U.S. resident and the other one's a
We showed that slide earlier.
Okay, so if one's a non-resident, they can file with the U.S. taxes.
Yes, correct.
Okay.
U.S. residents pay a preferential lower tax rate on qualified dividends and long-term capital gains. They're trying to encourage long-term investing. Generally, non-residents aren't here for the long term, so they're taxed at a flat 30% rate. And then U.S. residents may qualify for various tax credits. Again, the government's trying to encourage people to have more kids, encourage people to invest long term, to invest in home and things like that, invest in education. Again, we put this, it's just a 5-page document to help you as you put together your taxes. It talks a little bit about sprint tax and how you do it and things that you need for it too. So Sister Sedgwick and I did that yesterday and just hopefully can make it a little more interesting. So we're going to use this worksheet. For taxes, let's calculate. Bill and Stella.
Are you going to pull up the calculator?
Yeah, I'll pull up the calculator and we'll let someone want to volunteer to come up here and do it? Okay. So that is their gross income. Notice they don't have any adjustments. So that is their gross income. Now look, now they get to decide, are they going to itemize or are they going to take a standard deduction? Notice if you itemize, you can do things like charitable contribution, your tithing, state and local taxes, home mortgage interest, other taxes, charitable mileage. There's a lot of different things here they could do.
But their tithing was only $1,800.
Yeah, so it's not going to be enough.
And the standard deduction is $30,000. So I would rather use that.
So they're going to use the $30,000. Guess what? What's their taxable income? 0. Okay, come down a little farther. So their taxable income. Oh, let's go back up to the top. Okay, go ahead, come down. Okay, so notice these are the tax rates here. So married filing jointly, I don't know if you remember the previous one, it was 11,975 for filing singly. Now notice it's different here. So again, it's 10,000 on the first, 23,000.
But they don't owe any.
Yeah, so they don't know anything. So now let's come down a little farther. They have a couple of credits. They have one child. So let's put 1 here on child tax credit.
Down low, yeah, right there.
Okay. So notice it's 2,000 plus 1,400. And then let's look, how much taxes did they withhold?
1,000 plus 1,400?
Excuse me, 1,400 is refundable.
Right.
So let's come here and there. They paid $1,600 in taxes.
No, they paid $400 in taxes. They withheld
Withheld
16,000.
1,600.
16,000. They withheld.
No, they withheld 1,600.
Oh, 1,600. You're right.
Okay. So how much are they going to get back? They're going to get back $3,000.
Did you?
Why did that come about?
Did you include their $400 that they paid for state taxes?
No, because that's if you itemized.
Oh, okay.
Right. So again, so they're going to get $3,000 back. They're going to get all they paid plus $1,400. So notice what we have here. No liability, we 3,000. Total income is up here. Adjusted gross income here. Standard deduction, taxable income, tax credits, taxes paid, tax refund, and the marginal and the average tax rate. So again, marginal tax rate was 10%. Average tax rate, because they paid no taxes, would be 0. Also, for the international students, total income, adjusted gross income, itemized deductions, taxable income, taxes paid, owe to refund your marginal and your average tax rate. So the question is, could you do this for yourself? Because everyone here is going to have to do their taxes.
And it's due next week.
Yeah, and so you don't have to calculate your taxes for next week.
Yeah, but they have to do their marginal tax rate and their average tax rate from last year.
Yeah, so they just, for most people, it's 10%. Well, you can, as you look through this, you can kind of figure out. Go back and look at your tax rate. Yes?
What if you didn't work last year?
Didn't work last year. Your tax marginal was 0. And,
So it's just 0.
yeah, 0 and 0.
Yep.
But what tax forms are you going to use this year? So you know you're going to use a 1040 NR.
No, she's not a non-resident.
Are you working? You're an
Are you a
iWork.
non-resident? She's a citizen.
Oh, okay, sorry. Okay, you have dual citizenship.
Yeah.
Okay, but so what tax form, if you're a non-resident and you work, what's your tax form you're going to use next year? 1040 NR. How about Hawaii? Hawaii N15. So what are our takeaways?
So our takeaways are, so the Lord's in the small details of our lives, and it's His divine design. And we know that it's His plan for us to be here together at this time in this class.
Okay.
Thanks, everybody.
Thanks, everyone.